Well, Pat, great to see you. Before we talk about 2026, let's look in the rearview mirror a little bit back at 2025. Give us a wrap-up of last year, how things went, just generally speaking.
A crazy year, very volatile, I think in part because of all the trade policy commentary and then fixation on AI. It was really a year about tariffs and AI. And I think the constant change creates caution and uncertainty. And so it was a very neutral year economically. I think we grew about 1.8% is the estimate right now. Some people were expecting a recession, so that's not so bad. And I do think we'll have a positive year in 2026 also. But it would be really nice maybe to have a little bit more certainty around virtually everything. And I think things would calm down a little bit.
Yeah, the word you've used the last few years is certitude or lack thereof. And you just kind of alluded to that here. Doesn't seem like we're going to actually probably get that this year, but I want to get your 2026 forecast here in terms just overall, the real estate market, mortgage market, kind of what are you looking for here? Just paint the picture for us and we'll zoom in a little bit.
Well, I think the overall economy will be positive this year, 2 to 3% growth, maybe even a little bit more than that. We're a very fortunate country in that we have a lot of capital and we have a lot of international presence, regardless of tariffs. And I think we will benefit that. So I see the economy being fairly good. I do see uncertainty continuing to be a problem. So I don't see rates coming down very much. We could get into this in great detail, but our biggest problem here, and we don't talk about it, is the national debt. I mean, how do you buy our debt when we have $38 trillion worth of debt and $1 trillion a year in interest? I mean, it's an impediment to interest rates being lowered. And that in the high level of uncertainty. So I see 2026 being a positive year, but not a great year.
I want our audience to be able to take away what you just shared, to be able to share it with their audience, right? They may be talking to home buyers, or this may be lenders talking to agents out there. What do you mean when you say the debt impacts mortgage interest rates and the ability for those rates to go lower?
Well, we have to sell that debt, and the percentage that we sell that debt for has a lot to do with overall interest rates and how the Fed reacts to the overall interest rates. So, with the current level of debt and the current level of uncertainty, I don't see the Fed being too aggressive on lowering rates. There's just too many issues around potential inflation because of disrupting international trade. And the high level of uncertainty causes people to be cautious. I mean, let's be real candid. Affordability is a major issue with buying homes, but there are people who can afford to buy a home right now that are still sitting on the sidelines because of the level of uncertainty. And I mean, it's really hard to make a commitment to pay something for 30 years when you're really uncertain about what's happening. So we have a lot of issues out here that we could probably address more directly. I do think at some point we're going to have to start acknowledging the national debt again and dealing with it. The percentage of foreign borrowers that buy our national debt has declined fairly significantly from about a third down to about a quarter of all debt. So we put ourselves in a situation where it's going to be hard to get rates lower. Now, let's be really honest. I don't think you're going to see rates get under 5.5% again in the next foreseeable future. Mm-hmm. That does not have to be a horrible thing if, in fact, earnings continue to outpace both inflation and home price appreciation. My first 18 years in this industry, mortgage rates never got under 7.5%. But the benefit, the plus side of that was that the cost of a home was significantly lower, so the affordability was much higher. But people need to have certitude that their earnings are going up faster than inflation and home prices in order to step up and pull the trigger.
Well, that was my next question, affordability. Here we are in North Texas, where I'm based, and I see a lot more inventory than I did a year ago or a year before that. And yet the quandary, I guess is the word, is that prices have not adjusted a whole lot. I think across North Texas, correct me if I'm wrong, particularly the Dallas market, it's down about 3% year over year across the market, and it depends on the zip code, but we're not seeing a major price adjustment. Why is that? Why have we not, with more inventory, seen prices come down more, or will we?
No, the amount the prices declined has reflected the abundance of potential homes for sale, or the abundance of homes for sale. Prices don't decline dramatically unless you have some reason for people to have to sell the home now and take whatever they get, as we saw after the financial crisis when lenders foreclosed on a lot of homes and then dumped them in the market. We're not in that situation at all. Abundant supply now will cause maybe a 1% to 3% decline in prices. And we are seeing that in some markets where we have an oversupply of homes for sale, 1% to 3% decline in prices. That's about it, unless you have a traumatic event like a high level of foreclosures. There's a lot of markets where home prices are going up 1% to 3%, going down 1% to 3%. That's all very natural, and that reflects I guess basically the affordability and the percentage of deals being done. We do not have a financial crisis looming. We do not have a foreclosure crisis looming. We have 2/3 of all loans in the last 7 years have been over 760 FICO score. We are not going to have a major drop in home prices.
That begs the next question, the obvious one here. Where do we go from here? I mean, are we just grinding this out over the next few years as income catches up and maybe prices continue to adjust a bit, and then we hope that interest rates float down a little bit? Where do we go here? Because, I mean, we're kind of stuck, it feels like, right?
Well, are we stuck? No. Are we impacted and reticent to do things? Yes. We have to have, and I don't want to get political here, but we have to have a little bit more consistency out of the federal government, and so that people feel assured that things aren't going to radically change and interest rates aren't going to skyrocket or things aren't going to go in the tank. People are nervous right now because something new happens almost every day. So that impacts people. We've had about 2.5 years where earnings have outpaced inflation. My personal opinion, it usually takes about twice as long as the period of time that inflation exceeded earnings. And that was 2 years, from mid-21 to mid-23. Yeah. From mid-23 to now, we've had earnings exceeding inflation. About another half to 1 year of that, and people will get more confident. They'll be more at ease. I honestly think that by this time next year, we'll be a lot more optimistic than we are now. And earnings have not only outpaced inflation, they've outpaced home price appreciation the last year and a half. So I think you have that for another year to year and a half, and then people will get a little bit more confident about making a decision. As long as all the noise in the background dies down a little bit.
Well, we'll see about that.
Yeah.
So you think 2026 will be a good year, certainly maybe not a great year, but a good year for those that are invested in their business and know what they're doing, right?
I think 2026 will be a better year than 2025, marginally, but better.
Good to hear. Let's talk about the industry reset that we've gone through the past few years here. It's been tough for a lot of people. Many have left the business on the real estate brokerage side. The lenders, I mean, I'll tell you what, coming from that background, I have so much respect for what they've been through, and our friends in the title insurance industry, particularly on the agency side, managing their business. It has been a tough go. Talk about the reset that we've been through as an industry and how it's made us better.
Well, I think, it made us better. That's probably the question that still is out there. Are we getting better? I think so, and I think you think that also. It hasn't been a dramatic change yet, but you can see the underlying current is moving in the direction of some significant changes. Let's be blunt here and brutally honest. The exceedingly low rates in 2021 really caused a lot of players to enter this industry. They are starting to leave now. We probably have too many. We have too many of everything. We have too many lenders, too many realtors, too many title companies. There has to be some consolidation and a little bit more evening out, if you will, of the processes, and a little bit more effort on the part of everybody to make the process more efficient. We still take on average 45 days to close a transaction. This is absolutely insane. That was what it was 50 years ago when I first started in the business. This is crazy. The amount of money everybody has spent on technology, the amount of effort everybody has made to use technology, and especially with the emergence of AI, we need to get a much higher level of integration less data rekeying, and all of the above. What does that mean for the consumer? That means a more understandable and faster process, and a higher percentage of transactions will close.
Good to hear. Speaking of artificial intelligence, AI, we could do a podcast just on this probably, but
yeah, we could probably do 10 of it on this.
Let's get simple here. What's working and what's not working? How do you see this playing out?
Well, a lot is working. I mean, it's really had a profound impact on our company. Just give you an example, and I'm going to be looking at some notes here, so forgive me, but we open 100% of all direct orders now on AI. We do it error-free, and we do it twice as fast as we used to do it. We are doing buyer and seller packages with AI, saving about 30 minutes a package there. We built chatbot, or building chatbot for our underwriters so that people can ask questions and get answers on basic questions very quickly, instead of having to wait for someone to return a call. And then, we're doing all short form refis in Q1 on using AI, and we have about 8 other projects we have going on AI. So it's had a meaningful impact wherever you have processes that are repetitive or just change slightly because of regulations and state requirements, state to state. Our industry, and this is something that most consumers, lenders, and realtors don't understand, we're an insurance industry. We are regulated state by state, and business practices change state by state, and underlying database access changes state by state. So you've had a situation where we've had to do the same thing in different ways in multiple states. Well, AI will help us be able to automate those processes, make it more efficient, take time and cost out of it, and I think to the benefit of everybody.
One thing that's been consistent in the real estate industry and many others over the years is it's always been, and I contend that it will always be, a people business, though. So this doesn't mean that robots are going to be showing homes or closing loans, right? Let's be clear about that.
Yeah, no. This I don't think people fully appreciate how much work, detail, and methodology lies behind the process, partly because lenders, realtors, and title companies are all regulated differently by different entities in different silos and all have to comply. So there is I want to be careful here. Let's just say that there's a significant amount of duplication and inefficiency in the real estate process right now. And I do think the interaction with the customer still has to be in person. We still have to have the people-to-people segment of the business. But a lot of the regulatory and compliance issues can be addressed through AI and automation. And I think that will continue to evolve in a positive manner, hopefully lower cost and take time out of the process.
I've been saying it for years. It's the largest financial decision pretty much most families in America will ever make in their life. Trust is a huge, huge deal when it comes to that. And
it is all of it. I mean, it's not huge. It is essential.
Absolutely.
Right? I mean, is key. And for some reasons, some people still don't get it. But that personal interaction and that building of trust is absolutely key.
Couldn't have said it better. Let's talk about commercial real estate. I want to broaden the scope here a little bit. We haven't talked about this in a while. I talk about it a lot with people I know who are in the industry, and it really depends who you talk to, what sector they are in, how much money they have or don't have, how many assets they have that maybe aren't assets anymore. Give us your overall snapshot on the industry, and maybe we'll take a little closer look after I hear what you have to say.
Well, my personal opinion is that the general sentiment towards commercial real estate has improved dramatically the last couple of years, in part because most segments of the commercial market had a fairly significant decline in new construction. The last one to actually start declining was probably apartments. And that's been in the last year. You're starting to see the amount of new construction decline dramatically. We are now seeing a lot of commercial real estate advisors and analysts say, hey, now is the time to start getting back in and buying because prices are lower and the usage will be there. Now, a lot of conversation about working from home, but we're back to about 60% occupancy on office space, and that will go up with a recession. Once we have a recession, we'll candidly, and I don't want to see one, trust me. But when we have one, you'll see occupancy get up above 90% again. The rest of the commercial market has gotten more interesting, and with the outlook of global growth and improved economics, I think you'll start seeing more money coming back into the commercial market. It will take a few years to get back to normal. We got kind of out of whack there for a while, but we will get back there. It was a big investment vehicle for a lot of funds and a lot of Wall Street players. I think it'll get back to that level, but it'll probably take 3 to 5 years to get back to what we would consider a more normal market.
You know, it's interesting, Pat. We've seen some deep discounts on some pretty prestigious properties. So again, I said it depends, ... because it really does on who the investor is, what their timeline is, what notes are coming due or aren't due. And so, you know, you can, and I've seen some of our investor friends pick up some really good deals in some major markets. And then at the same time, it hasn't been a bloodbath where you've had these investors hanging on to these assets, even though they might be in default. So the dire situation that we heard about 2-3 years ago, it didn't play out that way, did it?
Not completely. It did in some markets more significantly than others, and in some segments of the market. But there are people stepping up and buying assets as prices come down because they do see a future. You know, we've had a couple here in Portland, Oregon. We've had a couple fairly large, relatively new office buildings sell for 25% of what they sold for a few years ago. But they sold, and people think they have a future, and they do. It's just, you know, this steep discount reflects the uncertainty over how long until we get back to normal. Yeah,
it's been interesting. I think that's a word that we've overused the past couple of years.
I'm tired of things being interesting.
Interesting, yeah, not in a good way. Let's wrap up talking about leadership. You have been in this business, as we documented over the summer, over 50 years now. WFG, 15 years. You built this company from scratch, literally a few desks. I'll never forget walking into that office in Lake Oswego, Oregon, back in 2010, and thinking, "Wow, this is pretty cool to see." And here we are now. You've got a big national company operating pretty much everywhere. Talk about leadership, and that's kind of a ambiguous, open-ended question, but I want to focus it in on where we're at right now at this time and place, moving forward. What's your advice? And it's going to depend a little bit on what sector of the business you're in, but overall, what's your advice to our audience on leadership in times like this?
Communicate. The biggest failure that leaders have, especially in down markets, is they become quiet. They go, "Oh, we can't do anything now, so we'll just sit back and wait till things change." Well, you have employees that are sitting there wondering what's going to happen. They're wondering what you're thinking. They're wondering if they should be looking for a different job. They're wondering if you're optimistic, you're going to be in business. They want to know what's happening. They're human beings just like you. So communicate. Make sure your people know what you're thinking, what you're trying to do, where you're going, and why. If you will communicate with your employees, the performance will go up, the morale will go up. I mean, everything will improve. I think along those lines also in communicating, I think you really need to talk a little bit about what your plans are, but you also need to have an understanding that planning is a dynamic process. You don't develop a plan and then, oh, the market didn't go that way, so we abandoned the plan. You change the plan and adjust the plan on a regular basis to reflect what's going on. And then you communicate that to your people so they know where you're going, why you're making the changes. It's really interesting to me, but you know, sometimes you have to reduce staff. It can be a tremendous drag on morale and really disincent a lot of people if they don't understand why and what's going on and what your expectation is for the future. If they understand that it's necessary and that you're still focused on growing and you explain that to them, they will accept it because, look, we're all smart enough to understand that it doesn't always go up. Things do get tighter, too. Things do get harder. You have to adjust. Make planning a dynamic process. Make sure you communicate that. And then also take a really hard look at what you are doing to improve the capability of your people. One of the things that we've done, I give Steve Zoning a lot of credit for this. We've created these advisory councils of top producers. So we have a good view into what the people at the street level are thinking. We've got a good view of what our employees are thinking, and we communicate that. We are dynamic about our processing, but we are also investing in our employees. Training your employees has a great benefit. Making sure your employees understand, okay, let me just share something with you real quick. Most people go, well, I train my employees. They know how to do this. Well, have you taught them what happens before they get a file or after they get the file? People are actually pretty smart. And if they understand the process and where they are in the process, they might have ideas to improve that process. So, invest in your employees, invest time in them by communicating, training, and making sure that you have a dynamic plan. Don't abandon your plan because the market goes a certain direction. Adjust your plan on a regular basis and communicate that.
Well, Pat, this series has been a vital part of that communication piece you talk about. We've been doing this for 15 years. Yeah. Back in the old days of radio, we've done podcasts, we're doing video now, and we have so many channels to push out this content. And what I appreciate about you is you've always been honest. There's so much phony baloney BS out there, not only in this industry, but everywhere now, right? Where, everybody wants to put their spin on it. Oh, it's going to be great. It's a great time to buy a home, right? That's a cliche in the real estate industry. You've always been candid, whether it's been good news or bad news. And oftentimes when a lot of us have thought, oh, geez, we're screwed, Uncle Pat steps in and says, I think we're going to be okay here. Just ride this out. So wanted to say that we appreciate your commentary and being honest with us, because it's gotten us through some rough patches and some rock and rolling times too. So thanks for joining us.
Well, and something, Brian, and I'll share this with everybody. I don't care where you are in this cycle or where you are in your business. There are always opportunities. Make sure you understand that. You always look for opportunities. Opportunities may be realigning how you operate. It may be refocusing where you operate. It may be increasing the intensity with which you operate. But there are opportunities out there. Communicate that to your people. Get them engaged, and they will bring opportunities to you. So, just summing it up real quickly, I think the economy is going to be a little bit better next year. I think real estate activity will pick up a little bit next year. I think I'm a lot more optimistic about 2027 in terms of seeing a significant surge, but things are going to get better.
That's great to hear, Pat. As always, great to see you. We'll talk again soon.
Likewise. Thank you.